5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Credibility concerns. Critics question the Fed's independence, warning of blurred boundaries. Chips exception. The U.S. considers approvals for exporting supplies to South Korean chipmaker factories in China. All of that as weak labour market data puts a jumbo Fed cut back on the table. Payrolls revisions and CPI on deck this week. And of course, that's what attention will be turning to as we see futures pointed higher. After all the roller coaster rides last week, we did finish the S&P 500 up 0.3% and with the Nasdaq 100 up 0.1%. So it was not a negative week last week in spite of everything. The dollar index a little bit weaker today. We have a stronger euro offsetting a weaker yen. We're going to get into those stories in just a few minutes. And I want to point to oil as well, because of course we did get some production back on the table from OPEC Plus at the weekend. The headline number, not the number to watch. Shelley McCroft of RBC pointing to this incremental production coming back online because some of it had already been back online. That's helping to support the market. Let's have a look at treasuries because that's where a lot of interest will be this week, particularly when we get that CPI data. The 30-year yield at 4.76. We did give back some of those moves on Friday. The 2-year yield at 350.08. Remember, towards the end of August, we were at 380 on the 2-year yield. So that's another full cut priced in and more. And that's what you're seeing in the swaps market as well. One cut and maybe a 10% chance of a 50 basis point cut. Well, let's get to some individual stocks to watch now. Over in London, here's Valerie Teitel.
Good morning, Bonnie. All of these stocks I want to mention today have to do with the S&P 500's new index inclusion. The first one being Robinhood, up 7.6% on the back of S&P Dow Jones on Friday, saying it will be included in the S&P 500 on the 22nd of September. Once a disruptor of Wall Street is now turning into a pillar of it. Robinhood up 7.6%. Another stock included in the S&P 500 is AppLovin. This is a mobile app marketing company. The stock has doubled since its April low, up another 7.5 on this index inclusion story. One stock, though, that was not included in the index is MicroStrategy. This is Mark Saylor's company called Strategy, previously called MicroStrategy, the Bitcoin holding company. That stock is trading down nearly 2% in the pre-market on the back of this disappointment. Bonnie, there has been some excitement priced into this stock after S&P Dow Jones included Coinbase into the S&P 500, maybe giving some hopes that they wanted to build out a crypto sector when it comes to the S&P 500, but a bit of disappointment there for this Bitcoin stock. Bonnie?
Yes, excitement, one word for it. Valerie, thank you so much. That is Valerie Teitel there in London. And later in the show, we're going to catch up with Thierry Wizman of Macquarie for his read on a big week ahead for U.S. data. Well, lots of global market moves this morning in Japan. The yen weakening after Prime Minister Ishiba said over the weekend he intends to step down. Joining us now is Bloomberg's Jill Desus. So a little bit of chaos, I think it's fair to say, in Japan. Jill, what happens from here?
Well, Bonnie, I think while the removal or the resignation, rather, of Prime Minister Ishiba was pretty widely telegraphed, the question, though, now shifts to who eventually replaces him. And so I think this is where in Japan it becomes really, really interesting because Ishiba, who came into office last year in a leadership race, was known for more of his, fiscal discipline. And I'm not sure that any of the major candidates in Japan right now actually still fit that particular mold. So we're actually focused on two who may come into the equation once a leadership election is held. We're expecting something as soon as October for that position. The first one is Shinjiro Koizumi. He's the son of a former prime minister who is really focused on reform. So he's expected to campaign more on reform if he does enter the leadership race. But I think a really interesting candidate is Sanai Takaichi. So she would become Japan's first female prime minister, but she's also somebody who is a protege of Shinzo Abe. So really more focused on that idea of looser monetary policy, the idea of potential fiscal expansionism. And I think that's where you might see some pressure on long-term yields were she to actually take that spot. But I think the bottom line here, Bonnie, is that we're looking at a pretty significant transition either way in Japan. There's likely to be more candidates enter the picture here, and I'm just not sure anyone really fits that mold of Ishiba. So lots of uncertainty over the direction that Japan's leadership may ultimately take here.
And certainly markets celebrating in their own way. We have stocks rallying in Japan today, Jill, and of course, as you say, risks mounting for particularly long bonds. Have we risk of a divergence here, depending on who the candidate is?
Yeah, and again, I do think that it's if it becomes Takaichi, who will point out came in second to Ishiba during the leadership race last time around. If it is her, I think that's where you see that pressure kind of increase. It could be that markets are already kind of looking at that likelihood just given her performance last time around. I think the other component of leadership, if she were to become prime minister, is that she really kind of leans more into the sort of the far right political sphere here. Again, I think sort of taking some cues from her from Shinzo Abe, and really would kind of pull that leadership party more toward the right a bit. I think, again, bottom line here is that there's just a lot of uncertainty in Japan right now, a lot of change, and ultimately some pretty interesting directions that this leadership could ultimately take. Right now, we're sort of gearing up for, again, that idea of a leadership race in early October, but we'll have to see sort of how that situation develops over the next few weeks.
The merry-go-round continues. Jill, thank you so much for all that context. That is Jill Deeses. Over in France, meanwhile, Prime Minister Bayrou faces a confidence vote later today that may cause the government to fall. Joining us now from Paris is Bloomberg's Caroline Conan. So, Caroline, is Bayrou's removal a done deal at this point? And if so, what's going to happen today and in the next few days?
Vonnie, let me tell you what happened in just the last few seconds right here. Michel Barnier, the predecessor of François Bayrou, was just here saying hello to me. He said, I know this situation well because he lived it just 9 months ago. 9 months ago, he was here in this National Assembly just behind me as Prime Minister, and his government collapsed over the previous budget. Now, French history seems to repeat itself. This is probably what's going to happen today again with François Bayrou. Michel Barnier's successor is likely to lose this vote of confidence that's going to happen this afternoon. He actually provoked this vote of confidence when he called it on August 25, saying that I want people to realize that the debt issue in France is the most important issue of all, and we need to tackle this in this next budget. The problem, Vonnie, is that, as you know, French National Assembly has been fragmented since the snap elections of last year. And even though a lot of opposition parties say they do agree on the importance of the debt issue, they do not agree with the method of François Bayrou, which is calling this vote of confidence before any discussions on the details of the budget. So 98% chances that we're going to see another French government collapse here today.
What are the consequences for the markets and the French economy? Is there somebody out there that can placate markets, Caroline?
Bayrou's fall is currently priced in. We've seen the CAC 40 falling. We've seen the spread between the French and the German 10-year yield widen by about 10 basis points since the announcement to around 80 basis points. Now, the question is what happens next? What happens next is, of course, in the hands of President Macron. Likely, he will name a new prime minister over the next few days. Perhaps he will call a socialist prime minister, which is something he hasn't tried yet. But the parliament is still fragmented, so a lot in the opposition are calling for new, snap, fresh legislative elections, perhaps around March, when France is already holding local municipal elections. That would make sense, so you don't ask the French to come to the polls twice. Of course, some opposition parties are also calling for Macron's resignation, which would be a further blow to the markets and which obviously would add pressure to French bonds and domestic stocks. But this is something that at the moment, President Macron has ruled out.
Caroline, thank you so much. We're anticipating a day of events there in Paris. That is Bloomberg's Caroline Conan. Now to the Middle East, oil gaining after OPEC Plus agreed to raise production over the weekend, but at a more modest rate perhaps, with the group signalling caution. Bloomberg's Anthony De Paola joins us now from Dubai. And Anthony, I was just quoting earlier Halima Croft talking about how this increase really isn't the headline increase. In fact, it's, a lot less than that. It's an incremental increase. Let's, before I come to you, listen to Jeff Curry of Carlyle Energy Pathways, who spoke earlier on Bloomberg on this decision.
Saudi Arabia is in the driver's seat again. They're the only ones with spare production capacity. You look at the United States, they're not drilling. Russia, flat to declining. And, over the weekend, you had Ukraine take some shots at the Druzhba pipeline. They're not increasing. So I'm going to ask you, where is this, oil coming from? Show me the spare production capacity. Where is it? I'm not going to say we're not going to get an inventory build or we're going to get a contango, but I think, what does this mean to pricing? is it's a very fine line between oil supply glut and running out of spare production capacity.
So, Anthony, do you agree with what Jeff Curry said?
Yeah, good morning, Vani. It is the Saudis that have the massive amount of spare capacity, the most that they can bring back to the market. And the Saudis have been one of the drivers behind the OPEC Plus decision-making for a while. And we've seen them kind of shift away from this idea of defending a higher price than where we are at now in terms of going back to this idea of getting more market share. And that's because the Saudis do have that spare capacity and that extra oil to bring on the market. You alluded to the fact that this is a smaller increase. They're putting on less than 140,000 barrels a day next month, starting next month in October. That's about 4 times less than what they'd been putting on the market in August and September. So reversing some earlier cuts and bringing back oil over the last 6 months. Now they're going to kind of slow that pace of increase over the next year. OPEC, of course, says if we do see supplies building up, we can slow down or reverse those increases. So they're giving themselves that flexibility. But the Saudis, who have got that extra spare capacity, they're the ones that want to put it onto the market. And a lot of the market watchers and barrel counters are looking at the fact of the production capacity from some of those other members in the OPEC Plus group. And they're saying that not everyone is going to be able to meet their own quota. Not everyone is going to be able to bring that oil back. The most of the spare capacity is here in this region. We've got Saudi Arabia, as I mentioned, the United Arab Emirates, Kuwait, and to some extent Iraq, who will also be trying to bring back production. So we'll see that coming back. It's going to be parceled between those members of OPEC Plus, so not huge amounts for each country, but we will see it coming back from those key OPEC Plus members in the Gulf, Fani.
And Anthony, what's the dynamic with the U.S. shale producers? Because obviously, there's a bit of competition here as well. Would OPEC Plus be happy with a lower price in order to maybe take some of the U.S. supply offline?
Well, OPEC is never really content with a lower price. I think they do see some of the writing on the wall here in terms of the geopolitical situation that Donald Trump does want lower prices. So they are gaining some favor in terms of putting more oil onto the market. But OPEC Plus has tried before to handicap U.S. shale. And what happened at that time when there was increased production, dropping prices there, U.S. shale kind of adapted, conserved cash, didn't really reduce production that much. And then once prices swung back up, they were a more efficient producers and came back into the market. We are seeing shale production in the market slowing, though, with the increase in the drop in prices and the increase in costs to those producers. But we are seeing also some oil coming on from countries like Brazil, like Guyana, so other places in the Americas. So there is growth in non-OPEC Plus supply, and that is a challenge to the OPEC Plus countries.
Anthony, fantastic context as always. That is Bloomberg's Anthony De Paula there in Dubai. Now to other top stories trending on the terminal this morning. London commuters are facing major travel disruptions as underground workers go on strike over pay. Stores, restaurants and bars in central London are expected to suffer most. The walkouts could cost the economy £230 million, or about $311 million. The disruption is expected to continue until late morning Friday. The EU weighing new sanctions on Russia. They're expected to hit about half a dozen Russian banks and energy companies. Sources say the bloc is hoping to coordinate some of its latest measures with the United States. China's export growth slowed to the weakest in 6 months as a slump in shipments to the US deepens. However, a surge in sales to other markets kept Beijing on track for a record trade surplus of more than $1.2 trillion this year. Coming up, President Trump picks his top 3 candidates for the Fed chair role. We'll dig into what one of these finalists is saying about central bank independence. That's next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Last Friday, Treasury Secretary Scott Bessent called out the Federal Reserve for putting its own independence at risk. He wrote in the Journal about the central bank's, quote, overuse of non-standard policies, mission creep and institutional bloat. NEC director and finalist for consideration to be the next Fed chair, Kevin Hassett, echoed Bessent on CBS.
Central bank independence is something that, as you saw, there was a hearing this week about that Democrats and Republicans in the White House all agreed about. Now, the question is, has the current central bank been as independent as we would like, as transparent as we would like? And I think that there's some dispute about that.
For more, I'm joined by Bloomberg's Kasia Klimashinska, who leads our DC breaking news coverage. Fed independence has been percolating for many weeks and months at this point, Kasia. Now it seems like those in contention to be Fed chair and actually doing the adjudication, Scott Bessent, are taking control of the narrative. Would that be fair?
Good morning. Indeed, the Fed and Fed's independence has been in focus since basically President Trump took over the White House, because Trump is pressuring the Fed. He wants the central bank to cut interest rates, and that is causing some concern among investors who, of course, want low interest rates, but also they want in long term the inflation to stay in control. And that's why the Fed's independence comes into focus. If the central bank is independent, it can focus on those prices. It can focus on basically doing its job in the economy. And we heard Kevin Hassett. Kevin Hassett is one of the top 3 contenders. President Trump on Friday listed them. It's the 2 Kevins and a Chris. So Kevin Hassett, Kevin Walsh, and Christopher Waller. And Kevin Hassett, a very close advisor to Trump, was there on TV networks on Sunday saying that he supports Fed's independence, but also he wants the central bank to kind of limit its focus to just monetary policy. At the same time, I think he calmed investors by saying that he doesn't have any big overhaul in mind.
Well, elsewhere, the US is weighing annual approvals now for exports of chip-making supplies to factories in China. Can you give us some more details on this particular story?
This story just landed, but it shows that the U.S. wants to control what exactly is flowing into the U.S. from China. So the Trump administration realizes that the U.S. still needs some of the gear that is currently being produced in China, but it wants to have a final say over what exactly and how many items are coming into the U.S. So the Trump administration will issue those kind of waivers or licenses to companies like, for example, Samsung, allowing them to bring some gear from China into the U.S., but only for a year at a time.
So it'll be conducted annually. Elsewhere again, federal immigration agents conducting raids across Boston over the weekend, and the president threatened Chicago may be next. What more do we know about what happened?
Yes, so these were federal law enforcement officials going into those cities and arresting dozens of people in Boston, and then Chicago could be next, perhaps also New York. As President Trump says, he wants to have control over the immigration. He wants to make sure that those jobs go to Americans. He wants to get rid of, workers who don't have permits to work here, and especially those who commit crimes. He wants them to go back into prisons or even back to the countries that they came from. So again, we saw a lot of action in Boston, in Washington, D.C. before, and perhaps Chicago or even New York could be next.
Yeah, and in fact, it also hit Georgia, an immigration raid on a Hyundai EV battery plant. What's the latest? Did it get reversed?
This was a very big story last week and over the weekend. This was a raid from federal officials on a plant in Georgia where 2 South Korean companies are building a plant to build EV batteries. More than 400 people were arrested, including 300 South Koreans. That was covered by South Korean newspapers over the weekend, of course, triggering an outrage and really a political crisis of sorts where the South Korean politicians had to intervene, and they will most likely get those South Korean citizens released. Perhaps they will fly back to South Korea on Wednesday. But in the meantime, also President Trump commented on the issue, citing it as an example of what needs to happen. He says that those foreign workers can come here, but they need to train Americans, and ultimately Americans need to learn to do their work.
Kasia, thank you so much for that roundup. That is Bloomberg's Kasia Klimashinska in Washington, D.C. Coming up, concerns grow among Republicans about RFK Jr. Plus, a look at what else is making headlines in your front page news. All next, this is Bloomberg. Time now for your front page news. First up on the New York Times, Russia unleashes its largest drone assault since the war began in 2022. Ukrainian officials said the assault damaged a key building in Kyiv's government district. It marks the first time a government building in Kyiv has been damaged in the war. Next up, on the Washington Post, growing doubts about Health Secretary Robert F. Kennedy Jr. among some Republicans. Among those speaking out is Senator John Barrasso of Wyoming, who is the #2 Republican in the Senate and is a medical doctor. Officials from Trump's first campaign administration are also increasingly condemning Kennedy, saying that his broader vaccine agenda was doing, quote, tremendous damage to public health. And the Wall Street Journal reporting OpenAI is lending its resources to the creation of a full-length animated movie made largely with AI. It's going to be called Critters. Do stay with us. This is Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Credibility concerns. Critics question the Fed's independence, warning of blurred boundaries. Chips exception. The U.S. considers approvals yearly for exporting supplies to South Korean chipmakers' factories in China. All of that as, of course, weak labor market data puts a jumbo Fed cut potentially on the table. Payroll revisions and CPI on deck this week. So let's take a look at where we stand futures-wise in the very early going. Futures pointed higher. Now, don't forget, we did finish the week with a weekly gain for the S&P and the Nasdaq 100 last week, 0.1% for the Nasdaq 100, 1/3% for the S&P, in spite of the whole roller coaster ride that we saw throughout the week. We also today have David Kostin saying we're going to see another 2% gain by the end of the year and a 6% gain for the S&P 500 by mid next year based on interest rate cuts. Of course, that all changes if we somehow lose control of inflation or if other variables change. The dollar index is a bit lower, but we are seeing a stronger euro and a weaker yen today, so there's a little bit of balancing going on. And I do want to point to crude oil as well. It is supported up about 2% after those increases that OPEC put on the table were perhaps not as crazy as the market was looking for, or at least the market had priced already in most of that. The 2-year yield, 10-year yield, 30-year yield, very little change today, but as you can see directionally we are getting that steepener continuing. That 2-year yield at 350 is quite the eye popper though. Let's get to some individual stocks to watch now though. Here's Valerie Teitel in London. Valerie.
Good morning, Ivani. Let's start with Robinhood, up 7.5%, nearly 7.5% on the back of S&P Dow Jones saying it will be included in the S&P 500 come the 22nd of September, once the disruptor of Wall Street is now going to join one of Wall Street's most exclusive clubs. That stock is in the green on the back of this. Another one that was not included in the index, we're seeing in the red, that's Michael Saylor's Strategy, previously known as MicroStrategy, down 2.3% in the pre-market trade. There had been some excitement priced into this stock on the back of Coinbase getting included into the S&P 500 and those thinking that perhaps that S&P Dow Jones wanted to expand the crypto sector, but that did not come through for Strategy Inc. That stock is in the red in pre-market. Lastly, I want to hit on Loan Depot. This stock went absolutely crazy on Friday, up 27% in Friday's trade, and pre-market up another 12.5%. Vani, this is on the back of perhaps some positivity in the stock after Trump's war on housing. Remember, it was last weekend we heard from the Trump administration that they wanted to declare an emergency when it came to housing and perhaps teasing some extraordinary government measures. And we're seeing those that extend these residential mortgages, such as Loan Depot, being some of the key beneficiaries from that skepticism. Bonnie?
I can tell, Valerie, it's going to be a fascinating week once again in markets. That is Valerie Teitel in London. Another big week then in economic data. Tuesday, we'll get those annual revisions on non-farm payrolls from April last year to March of this year. Then, of course, PPI Wednesday, CPI Thursday, and New Michigan Sentiment Friday. All that after last week's jobs report, which has cemented a Fed cut next week, at least in market pricing. Joining us now is Thierry Wizman, Global FX and Rates Strategist at Macquarie. Thierry, thank you so much for joining.
Good morning, Bonnie.
So Standard Chartered now looking for a jumbo cut, but not quite sure what happens after that. We have Bank of America putting 2 cuts on the table, where previously they had none. Is there any scenario where we actually don't get a cut next week?
I really don't think so. I mean, there's of course a slim chance that the CPI report for August comes out and it's high. It may be high, but even if it's marginally higher than expectations, I don't think it will cause the Fed to not cut effectively or hold back. I think it would have to be very high. Now, obviously, there's a small chance of that happening. Data, to some extent, is unpredictable. The Fed probably at this point does not know what the CPI is. I do think the Fed will cut on September 17th, but there's, of course, always a little chance that the data will derail that vision.
If the Fed decides to go 50, which would be, the other side of the coin, does it risk panicking markets that it's playing catch up and too late?
I think it risks panicking markets because the market will undoubtedly believe that the Fed knows something that the market doesn't about the direction of the economy. There's obviously already a lot of concern around the direction and outlook and robustness of the labor market. And given that the Fed has already said that it is going to pay a little bit more attention to what's happening in the labor market as opposed to paying attention to what's happening with inflation, i.e. shifting the focus of the dual mandate towards unemployment, I think that the market will infer from a 50 basis point jumbo cut that there is something much more seriously wrong about the labor market than the data has led on so far. So yes, I think that it could, in some quarters at least, create the sense that we're going to have a recession. I don't think we're going to have a recession. I don't think the Fed necessarily wants to behave in a way that it conveys to the market that it believes that either.
Now, we're looking at a 3-month average of 29,000 jobs created in the economy. We may get revisions tomorrow that maybe even put a month or more into negative territory from previous months. And of course, we have the unemployment rate now at 4.3%, which we haven't seen for 15 months. How concerned should the Fed be about this labor market?
It should be a bit concerned. I don't think it should be overly concerned. Remember, I say a modest amount of concern. Because we don't really know yet if the decline in non-farm payrolls growth has been due to the reverse immigration issue in the United States. There is a possibility that 30,000 jobs to 50,000 jobs per month created is exactly what one would expect in view of the reverse immigration we're seeing and the prospect that we're seeing a decline in the labor force itself as a result of this. So it should be concerned, but it should temper its concern with the possibility that there's something else going on. And I think the other thing that's going on is the fact that the unemployment rate being at 4.3% is not overly high. In fact, it's still below what the summary of economic projections had implicitly predicted for where the unemployment rate would be at the end of this year. So it's not a cause for concern, for panic yet. There is a modicum of concern, I think, that's building.
So, Terry, 25 basis points then next week would be your base case.
That's right.
What do we get then for the rest of the year? Do we need to keep going with the cycle?
I think when the Fed starts to cut, it's usually signaling that it's committed to more cuts. It wouldn't just do one unless it believed that there was a little bit more effort needed to bring the labor market back into a more robust equilibrium. So, yes, I do believe that the Fed is going to cut again this year. It may, in fact, skip one of the meetings between now and December. It's not clear that it will do 2 more in a row. But I think all told, we're looking at about 3 rate cuts of 25 basis points before the cycle ends. That is a much more hawkish view than the market is offering us right now. If you look at the swap market right now, you look at the forward curve implicit in the swap market is talking about 5 to 6 cuts coming in the duration of this easing cycle. We think that's excessive, and one of the reasons we think it's excessive is not because we are very optimistic about the economy right now, but come 2026, you will see fiscal stimulus coming out of the One Big Beautiful Budget Act, and we think that the economy will recover at that point.
Yeah. So we saw a lot of volatility in rates markets last week, to say the least. Is the 25 cut priced in now, or do we see more volatility in coming weeks? I mean, 350.
Well, again, the 20. We can't see that much volatility because we're not that far away from the Fed's meeting on September 17th. So there's a certain amount of limited range that the market can move over the course of just a few business days. But I will say again that the primary issue going between now and September 17th in the meeting will be the CPI number. Remember, the CPI has been sticky. Inflation generally has been sticky on the way down in the U.S. We are seeing evidence that there is positive pressure on goods inflation. And keep in mind that some of these indicators of cost, both on the services side and the manufacturing side, like the ISM prices paid surveys and business prices paid survey, are still signaling that there's upward inflationary pressure in the U.S. So that is my concern. Do I think that it'll turn off the prospect of a rate cut? No, it'll still happen. But the market may adjust the outlook for future Fed cuts if CPI is high.
We have a lot of talk about Fed independence from the Republican side at the moment. I'm curious as to whether these questions are priced into the Treasury market. I mean, we have the 30-year yield right back down to 4.7725. Clearly, you know, all eyes are on the FOMC at the moment. But will Fed independence and this whole question and who gets to be next chair and so on have an impact on particularly the long end?
Yeah, absolutely. In fact, it's having an impact, I believe, not just on the long end. We could talk about that, but it's having an impact on the forward curve that I alluded to earlier. 18 months out. Remember, that forward curve is projecting that the Fed will be cutting by 5 or 6 times over the next 18 months or so. And I just said earlier that I don't think it's going to cut by that much. But one has to try to rationalize why the market is pricing in that aggressive a path for rate cuts. And I think it's one of two things. It's either pricing in a recession or it's pricing in a loss of autonomy on the part of the Federal Reserve due to the leadership changes that are going to cause the Federal Reserve to be much more structurally dovish than it is right now. Those are two ways to rationalize what the curve is saying.
Very briefly, Terry, dollar call.
Yeah, no, we still think that the U.S. dollar is going to weaken from here. A lot of the weakening has already taken place, so it's not as if the next few months are going to see massive dollar weakening. There are things that could interfere with that view. Obviously, what's happening in France with the fall of the government can interfere with that view and bring money back into the U.S. But generally speaking, the trend is still lower for the dollar.
Terry, thank you so much for joining us in studio early this morning. That is Thierry Wizman of Macquarie. Coming up, Fed Chair finalist Kevin Hassett echoes Treasury Secretary Scott Bessent in calling out the central bank. More on that next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Treasury Secretary Scott Bessent called out the central bank last week for risking its independence by overusing, quote, non-standard policies, mission creep, and institutional bloat. Kevin Hassett, NEC director and finalist for consideration to be the next Fed chair, was asked for his view on Fed independence on CBS yesterday.
Central bank independence is something that, as you saw, there was a hearing this week about that Democrats and Republicans in the White House all agreed about. Now, the question is, has the current central bank been as independent as we would like, as transparent as we would like? And I think that there's some dispute about that.
For more, I'm joined now by Bloomberg's Kasia Klimaszinska, who leads our DC breaking news coverage. So, Kasia, we have been talking about Fed independence from many angles for many weeks and months, and suddenly it's the Republican narrative. What are Fed watchers saying about Bessent and Hassett's remarks?
Good morning. Indeed, we saw Kevin Hassett here. Hassett is one of the top contenders to lead the Federal Reserve after the term of the current chair, Jerome Powell, expires in May. So Hassett went on TV on Sunday and he kind of echoed this narrative that is coming from Republicans, that the Fed is doing too much, that it's expanding beyond its core mandate of monetary policy into perhaps financial regulation or even looking at issues like climate change. And so Hassett reiterated that the Fed independence is key for him, but he would like the central bank to focus on its core mission of monetary policy. And that's also what the markets want. Markets want the Fed to stay strong and independent so that it could keep the control of prices, so that it could prevent the prices from spiking. And you had your earlier guest pointing to rates, especially long-term rates, that show that there is some concern in the markets now about whether those prices will stay in check, whether inflation will stay in check over the long term.
Meanwhile, also in DC, the U.S. weighing annual approvals now for exports of chip-making supplies to factories in China. So what are the details here?
Yes, this is just a proposal, so we are in early stages of solving this issue. We know that the Trump administration wants to limit how much of IT gear is flowing into the U.S. from China. So it revoked licenses from some companies like Samsung, for example, preventing it from just bringing semiconductors from China into the U.S. And now the two sides are looking into how to solve it, because the U.S. still needs some of those items, some of its gear. We cannot produce all of it in the U.S. yet. So perhaps there will be those annual licenses telling companies exactly how much and exactly what it can bring from China to the U.S. each year.
All right, Kasia, thank you so much for joining us. That is Kasia Klimaszinska in D.C. Companies around the world still grappling with trade uncertainties with the U.S. Volkswagen Group CEO Oliver Blume spoke with Bloomberg's Stefan Nicola on the sidelines of the Munich car show. Take a listen.
We welcome the joint agreement between US and EU with the opportunity to come to a signed agreement retroactive from the 1st of August on. And that gives us planning security. On the other side, the 15% would be a burden for Volkswagen Group. That's very clear. And we don't appreciate the asymmetric deal in between US and EU, because it's distorting the competition in Europe. And therefore, we are counting on our own offer, investing heavily in the US, linked to our growth plan we planned in the US. And there we are in a close contact and good talks with the US government. And we hope that we come to a quick solution also during the next weeks with the support from the US government to our investments, because we think that's very attractive for the US community, building employment, building a supply chain, and that at the end gaining taxes in the US. And that is positive and a better multiplier than having on the other side the tariffs.
Yeah, let's stay in the US for a second. You've long wanted to grow there, and you've made some investments in the Scout brand, for example. Now, things have changed. President Trump is cutting back on EV aid, the tariffs we've already discussed. How do you adapt your North American strategy to those new realities?
Yeah, we are investing heavily, for example, in Scout or in Rivian and other tech partnerships in the US, and we see still a huge growth opportunity for Volkswagen Group with all our brands. And Scout is one positive example to enter now in the biggest US car segment, pickup segment, and the huge rugged SUVs. And Scout stands for this segment, to bring back a heritage US brand to the market. And what we are offering there is also a car with range extender. You have an internal combustion engine, and offering a huge mileage with these cars, around 800 miles. And I think that's very attractive for the US community. And the car is stunning. We were able to present it also yesterday here in Munich. And everybody is excited, and also the first order intakes are very, very positive for this car.
So no changes to Scout. You're doubling down on that brand and that introduction.
We are counting on Scout, and this is one very important driver of our growth strategy in the US.
Bloomberg's Craig Trudell, who leads our global autos coverage, joins me now. So, Craig, very difficult time for European, well, global automakers, really, but dealing with the US, and the Volkswagen CEO didn't hold back there. What's the outlook for potential deals with the US for European car makers, and would they all get the same one?
Yeah, you heard Bluma talk there about not appreciating the fact that we're now in a situation where the tariff rate going from U.S. to Europe is nothing versus a 15% from Europe to the U.S. And that, of course, is not something that the European car makers are particularly happy about, in part because they are a sort of bright spot in this story of lopsided automotive trade between the U.S. and Europe. You have German manufacturers in particular sending quite a lot of vehicles from the U.S. To Europe. And yes, they're also exporting a lot from Germany and from the rest of Europe into the U.S. And that is, the sort of reason that Trump wants a big change in terms of approach to trade with Europe. But you do have an effort on the part of these manufacturers to try and get some recognition for the fact that, if they're going to, be a part of the limited amount of exporting going on from the U.S. to Europe, that they should have some offset there, some recognition of that in terms of how they're tariffed going forward.
Craig, how is the rollback of emission standards in the US going to affect, global automakers, European and Chinese automakers in particular, who are in a fierce fight on the EV front?
Yeah, I think, you heard our colleague Stefan ask about the Scout brand. I think that is really an interesting sort of question going forward, because initially that was going to be an electric-only brand. Pickups and SUVs that Volkswagen sort of reckoned would be, where the American consumer would be most likely to go electric. What we've seen is real sort of disappointment and letdown in terms of just how quickly the American consumer is willing to buy EVs, even in those segments that are more popular in the U.S. And they've had to kind of pivot in terms of their strategy for Scout, where it's now not going to be electric only. It's going to be electric and range extended electric vehicles, which is, a sort of glorified hybrid. And they're having to do that in part because the demand hasn't been there, and because the equation is really changing, as Stefan alluded to, where you now have IRA tax credits going away after this month. And, a real question about just how supportive the U.S. is going to be from a policy perspective for years to come for electric vehicles that already, weren't really taking with the consumer.
Craig, thank you so much. All of that there from Bloomberg's Craig Trudell, who covers autos for us. Coming up, we'll get you set up for your week filled with economic data. This is Bloomberg. Now a look at what's ahead this week. Annual revisions for non-farm payrolls coming out on Tuesday morning will be closely watched, of course, followed by PPI Wednesday and that all-important CPI report Thursday. Friday, we also get Michigan. And we wrap up the week with that University of Michigan sentiment data Friday. Fed watchers will be looking at inflation expectations in particular. So a morning of new S&P 500 entrants, AppLovin and Robinhood rising ahead of being included in that index. Oracle sees its price target raised by Barclays thanks to inking that $30 billion deal with OpenAI back in June, and it's up more than 2% pre-market. Some nice moves to the upside there. So let's take a look at markets more broadly, because of course we have that hugely disappointing jobs data, which, caused the market to rebound as it does, equities wise at least. We do have another positive day potentially on deck today, with S&P futures pointed to a 0.25% rise at the open, NASDAQ 0.4%. They both did end last week with small gains. The dollar index very slightly weaker. We have a stronger euro today and a weaker yen. Lots of chaos and lots of elections and pre-election movement to watch. But I want to take a look at treasuries, because now we're all focused on next week's FOMC. We have Standard Chartered now calling for a jumbo 50 basis point rate cut in September, followed by question mark for the rest of the year. We also have Bank of America now putting 2 rate cuts on the table for this year. Swaps market, though, pricing in a definite rate cut next week and maybe a 10% chance of a 50 basis point cut. So lots of conversations to be had. That's it, though, for Bloomberg Brief. Surveillance continues the conversation. This is Bloomberg.